In this lesson, we're going to begin looking at one of the more advanced concepts related to merger models, which is the notion of revenue synergies. Now, a synergy in the context of a model like this, and really in almost any context in finance, a synergy is referring to a situation where 1 plus 1 equals 3. So in other words, you take two entities and when you combine them, you get more than you bargained for. So you think it's just going to be a simple combination of the two entities, but it actually turns out to be more than you thought, or sometimes it turns out to be less than you thought. In this example, we're dealing with revenue synergies, so we're strictly going to work on the side of combining two companies' revenue numbers and having a situation where we actually get additional revenue above and beyond that. So remember that in the merger model here, we had revenue for Apple and then revenue for RIM. And for our combined revenue down here, we simply added up these two numbers. And we assume that when we combine these two companies, we simply add their revenue in each year. And there's nothing wrong with that assumption, but what actually happens is when two companies merge, often the combined revenue differs from what you would expect by just combining the two companies' revenue numbers. So just as an example of this, let's say that right now RIM is selling BlackBerries with an average selling price of $300. And if we go into the equity research report, which I have up right here, on page 4, I'll zoom out. On page 4 of this report, just before the income statement for RIM, they actually have a projection for the market size for the smartphone market right here, and an estimated number of BlackBerry shipments each year. So what we could do is actually go into this and we could project out how many BlackBerries RIM is shipping each year. So we can go back here and let's say the number here is 47 million. So if we were just looking at Apple's revenue and RIM's revenue and combining them, we would just take these numbers as is. We'd say that they have an average selling price of $300. They're shipping 47 million a year. That equates to a certain amount of revenue. But with revenue synergies, by contrast, we would say something like the following. Instead of an average selling price of $300, maybe it goes up to $330. Why does this happen? Well, because now with the BlackBerries, they're now packaging iPhone applications. So in addition to the standard BlackBerry apps, Apple is now making their iPhone apps available on the BlackBerry, and so the average customer value may go up from $300 to $330. Also, Apple can now distribute BlackBerry. So maybe instead of 47 million in shipments, maybe it can go up to 50 million or 60 million or anything else like that. So these are both examples of what are known as revenue synergies, cases where you combine two companies and you get more than the expected revenue. Usually the way it happens is what we just went through here. Either the average selling price goes up, so you have an ASP increase or an increase in the average customer value because you can sell more products to the same customers, you can raise the price somehow by offering more from the other company, or you have a distribution increase. So before maybe RIM had a certain number of distribution channels, but now that they have Apple as their partner and as the parent company in this case, it opens up a lot more in the way of distribution, retail, and such. And so they have an increase in the distribution of their products. So these are two very common examples of how you get revenue synergies like this. Oftentimes people talk about cross-selling and upselling, and these are really both examples of an increase in the average selling price. Cross-selling refers to one company making its products available to the other company's customers. So a perfect example here would be making iPhone apps available on the BlackBerry. Upselling would be coming in and offering customers an additional product or something else that's of higher value when they go and purchase one of the seller's products. So these are some common ways that you can actually get revenue synergies in the context of a merger model like this. Now, when you're actually working at a bank, sometimes you do a lot of work into projecting what revenue synergies might look like and figuring out unit by unit what kind of synergies you're going to get, what kind of increase in the average selling price or the distribution you're going to get. We're not going to get into that level of detail here because you're not going to get questions that are quite that detailed in interviews, but you already have a basic sketch of what we would do. We would just be modeling out how many units they're selling and if those increase, and then the average selling price and whether or not that increases. And that's how we would create an estimate for revenue synergies. In this case, though, we're actually going to do something even simpler, which is we're just going to assume a percentage increase. Now the revenue synergy percentage here, this could be based on either the seller's revenue or the buyer's revenue. Most of the time though, you're going to base this on the seller's revenue. I'm going to enter 10% there. So we're assuming in this merger model that RIM's revenue will go up by 10% as a result of being acquired by Apple. And again, the basic assumption behind this is that either their average selling price, the average customer value will go up, or they'll be distributing more units, or possibly both. Oftentimes in models, when you just want to get an estimate, you can make a simple percentage assumption like this. However, on the flip side, remember that it's all well and fine if we get extra revenue, but with that extra revenue comes extra expenses as well. Specifically in this case, we're going to assume that cost of goods sold also goes up to correspond with this increase in revenue. Now we could also assume an increase in operating expenses here as well. It doesn't really matter, but usually with revenue synergies, you're assuming an increase in COGS instead, because a physical product such as an iPhone or BlackBerry is always going to cost something to sell. So it's usually more standard to assume that cost of goods sold goes up in response to these revenue synergies. Now in this case, to get an idea of what these might be, let's take a look at RIM's existing margins. So I'll just take their gross profit, divide by revenue, comes out to around 43 or 44%, around 43% here. So it looks like they're running between a 40 and 50% margin in their business. If we wanted to, we could base the revenue synergy percentage off that. But in this case, if Apple were acquiring them, then the cost of goods sold would probably decrease by a bit because many of the revenue synergies would probably come from cross-selling software, which has a lower cost of goods sold compared to hardware. So we're going to go with an assumption of 50% here for the revenue synergy COGS percentage. So with these assumptions in place, let's go down to our combined income statement now and modify this. You see I've entered two new lines for revenue synergy and revenue synergy COGS. So the cost of goods sold associated with those new revenue synergies. For the revenue synergies, what I'm going to do here is go over to RIM's revenue. And I'm going to take that and then multiply by the revenue synergy percentage right here. I'm going to anchor this with F4. Then I can just copy this formula over. So we see it's around 1.7 billion in year 1 going to 2 or 2.1 billion in year 2. Now we're also going to have to assume a certain cost of goods sold on that. So we're going to take the revenue synergies right here and then go all the way up to the top to our assumptions and multiply by what we're assuming for cost of goods sold here, the 50% number. And I'll anchor this with F4. So we have that, and I'll copy that over to 2011 as well. So here we're assuming a 10% increase to Research in Motion's revenue, and along with that, on that additional revenue, we're assuming a 50% margin in this case. The last thing we have to do here is modify gross profit to make sure that we're taking into account all these new items. So what I'm going to do here is take our combined revenue, add revenue synergies, subtract cost of goods sold, and then subtract the COGS from the revenue synergies right here. So we have that. Just paste that over to the next year as well. Now let's take a look at how our accretion dilution has changed. So overall, it's significantly more accretive now, 13% and 15% right here. Let's just go back to the old way. So we had 8% and 10%. So it's gone up by quite a bit, by around 5 percentage points in each case. So the revenue synergies here are significant because we have almost 2 billion and almost 1 billion extra in gross profit. So there's a pretty big impact on the accretion dilution overall. And that's pretty much always the impact of revenue synergies. They're always going to increase your accretion because additional revenue is always going to lead to additional operating income and then additional pre-tax income. So that's a quick example of how we would set up revenue synergies, what the concept actually refers to, what it might refer to in the case of a merger like this with Apple buying Research in Motion, and then how we actually incorporate it into our model and come up with a couple simple assumptions that we can use to reflect revenue synergies and the expenses associated with revenue synergies on the combined income statement. Coming up in the next lesson, we're going to be looking at another example of synergies, which is the expense synergy. So we're going to be looking at ways that when Apple and RIM combine forces, they can actually save money, they can save on expenses and use that to also boost the combined company's earnings per share.